Welcome to the Propertybuyer Podcast, where we explore the world of residential and commercial real estate to help you make better decisions about buying, selling, or investing in all types of property. Join me, Rich Harvey, CEO of propertybuyer.com.au and multi-award-winning buyer's advocate. Our podcast features expert interviews, market trends and insights, and practical tips for navigating the complex world of Australian real estate. Whether you're a home buyer, a seasoned property investor, commercial buyer, developer, or simply curious about the property market, our podcast is for you. Join us as we share our knowledge, strategies, and experience and help you achieve your property goals. Well, welcome to our next edition of the Property Buyer Podcast, where we empower home buyers, property investors, and commercial investors to make confident and informed decisions. Today, we're diving into one of the most critical aspects of buying property and investing, and that is the topic of finance. In this episode, we'll explore how to set up the right financial structures, how to navigate lending options, and create a robust strategy to build and grow your own individual portfolio. To guide us through this, I'm thrilled to welcome Josh Corley. Josh is a seasoned finance broker and a partner at the Brokerage. With a wealth of experience in property finance, Josh has helped countless investors unlock their potential by structuring finance solutions that pave the way for long-term success. Josh was a finalist in the Mentor of the Year by the Better Business Awards in 2023 and was also awarded the CEO Award during his time at Westpac. Josh is a keen runner and he loves touch rugby, and he also likes to travel. So Josh, there's your introduction. Great to have you on the podcast today.
Thanks, Rich. Appreciate it.
Pleasure. So Josh, before we dive into the questions around money matters, I've just got a little thought of the week to ask and get your feedback on. And this is a quote from a guy called George Adair, who said, "Everything you've ever wanted is on the other side of fear." What do you take from that quote?
It's sort of like being on your first ever podcast, right? Look, nothing good comes easy, so you kind of got to push yourself to get out of your comfort zone. And I think you're only going to get so much reward if you don't take much risk. So I'll take from that, push yourself, get yourself out of your comfort zone, and then good things will come.
I think fear stops us from doing a lot of things. I mean, when you're a kid, you used to fear maybe getting on a certain sports team, or as you get older, you fear public speaking. That's a big one, right? People fear doing podcasts. People fear, talking in front of their team members. But, I remember just freaking out talking in front of a group 20 years ago. And now it's sort of like second nature to me. It doesn't worry me. But I think it can really paralyze a lot of people, don't you reckon?
Yeah, absolutely. And you're right. It's public speaking piece. The more you do it, the more comfortable you get with it. And it's probably like taking any risk. The more you do it, then the more you get comfortable and the better it becomes.
I think it's also, we'll talk about fear of debt, but I used to have a fear of debt when I was younger. And, I remember signing my first mortgage documents with my hand shaking, thinking, oh, what am I doing getting into debt? And then I understood the difference between good debt and bad debt. But I'm sure we'll get into that. But before we do, Josh, just tell us a little bit about yourself. What's been your journey in getting into the finance industry, and tell us about your role at the Brokerage.
Yeah, for sure. So I started in finance in 2008. I was studying finance at uni and I was working at Westpac. I was there for around 11 or 12 years. My most recent role before I left was lending area manager of the Brisbane City region. And I guess when I was there, I had a great time. It was a really good place to work and you learnt heaps of things. And towards the end of my tenure there, this word broking or mortgage broking kept on coming up. And I saw lots of clients that we used to have sort of navigate towards, mortgage broking, and even my mates started using brokers instead of my team. So I thought I probably got to investigate this a little bit more. And I did know a really good commercial broking finance firm that wanted to expand into the residential market. And that's where I am today. It's called the Brokerage.
Fantastic.
I've been there probably 5 years now. I'm one of the partners, as you mentioned earlier, and my role is the general manager of the group. So we're based across Brisbane and Sydney, and we have around 25 people across the group. And we have 3 divisions. So we've got our commercial, residential, and private arm. And my role day to day is to oversee those and to look after the day-to-day running of the business.
Fantastic. Out of interest, do you know what proportion of people use mortgage brokers these days? Like in the whole mortgage market, people used to go to the banks, right? But do you know what percentage of people use brokers now?
Yeah, it's over 70. So the last data
Over
last quarter
70%.
came in.
That's
Yeah,
awesome.
over 70 now.
Yeah.
Yeah. Yeah.
There you go. Fantastic. Well, I guess a couple other questions for you, Josh, is just want to talk about structuring. Why is getting the right financial structure really important? If you want to buy multiple properties and build a portfolio, what does that structure look like? Can you just unpack that for us?
Yeah, it is very important. It is quite unique depending on each particular individual. And that's why it's so important to get right, because there's no one structure that suits all. But as you mentioned, if you want to buy a big property portfolio and that's your goals, if you don't structure yourself right the first time, then that could have big implications down the track, and it could actually stop you from being able to purchase the property that you want to buy. I'd say from the financial side, serviceability is a big thing. So if you don't structure yourself right the first time and you've got property purchased in entities that it shouldn't be, then that is potentially going to impact your ability to buy down the track. I'd probably just comment around the financial structuring side. There is two other key components of it. One is, yeah, as I mentioned earlier, how you buy your property, and a lot of the time that comes from a lawyer's advice. There's how you structure it in terms of tax purposes, and that obviously comes from your accountant.
And that's more about what name you buy, whether you buy in a personal name or an entity or a trust or a company, right? That's
correct.
Yeah.
Yes.
Yeah. But I think what we're talking about here today, which I really want to focus on, is the type of lenders that you go with. And I think one thing that a broker taught me very early on is, and we can talk about this a bit later, is do you put all your eggs in one basket with a lender, or do you spread your lending across, or is it very much a tailored solution for each client?
If you spread so you could do it a few different ways. As I said, it's quite unique, but there's a con in having your lenders spread, and there's lots of pros. So a con in having your lenders spread is that you deal with different lenders.
Yeah.
But I guess the role of the mortgage broker is to take that angst out of the end client. If you do have your lending spread, then as I mentioned earlier, like serviceability is a big thing. So lender X on one day might give you $1 million, but the next day they might give you nothing.
Yeah.
And then you sort of, look over to the lender over the fence, and then they'll be able to do the deal for you. So having a spread and relationship of lenders is really important.
What are some of the biggest challenges that everybody faces, that investors or home buyers typically face today? What are the biggest challenges they have, and how can they really overcome those lending challenges?
Probably one that's popped up the most in the most recent years is around credit scoring. So historically, banks didn't have open reporting around people's performance on their loans and their accounts. And that's really popped up a lot lately, because gone are the days that you could just forget to pay your annual credit card fee or, have a direct debit that was meant to come out. You didn't have enough money in the account. That actually gets reported these days. And we are seeing really good borrowers, really good people, have to pay more on their rate because they've had, a couple of those come up on their credit scores. So I'd say that's one that we didn't see as much, but definitely a lot more now.
So pay off your credit card is a key thing, right? That's a good message from that one. Yeah.
Pay off your credit card, leave money in your bank account. If you've got direct debits coming out, have a bills account with plenty of money in there, so it's not going to get overdrawn. And just protect yourself from that.
Yeah, great. Was there another challenge you were going to mention?
I was going to mention serviceability. So as I sort of touched on previously, serviceability can be a challenge. But if you get the right advice and you structure it right, then you can buy the property. Quite often we see people go direct to a lender and get told no, and then they go, okay, well, I can't buy this property now. But when they get referred to us, we go, well, yes, you can. You just got to structure it this way. So serviceability can be a big part of, as I said before, lender A might give you such and such on this deal, but on another deal, that same lender won't give you anything. So it's really, really important to structure that right.
Yeah, I reckon serviceability is the biggest thing. I reckon that's one of the biggest hurdles that everybody's got, because a lot of people run out of serviceability as they kind of go down the track of buying multiple properties. So I kind of just want to talk a bit about you tailoring those strategies. How do you, like when a client comes to you, right, and they want to buy a certain number of properties or they've got a certain goal, how do you customize that? How do you align the lending to achieve that goal? And is it realistic or is it unrealistic in some cases?
Look, yeah. So we sit down with the client and understand, I guess, what they want to do today, what they want to do in the future, and then we sort of work out a strategy behind that. Sometimes it is unrealistic, and if it is unrealistic, we sit down with them and go, well, if you want to achieve this, then we sit down and help them with a roadmap on how many years it would take for them to get there and what they need to look like to be able to get there. We like to think most of the time it is realistic. And when they do that, we'll sit down and go, okay, here's a strategy. And if they really want to stretch themselves and take, as you mentioned earlier with that quote, a little bit more risk, and they really want to stretch and back themselves, quite often a mainstream lender won't support them in those type of transactions. And they may need to go to that tier 2, tier 3 type lender who will back them. They'll pay a little bit more money. But when we have that conversation with the client, we go, well, this might be your option for the next 2 or 3 years with this lower tier lender. Let's help you get into this position. So we have an exit strategy to get you back to paying a more sensible rate. And quite often clients do that because historically they see the increase in how properties performed. And they go, if I miss out on this property, then I'm going to really be kicking myself. So that's sort of a basic way of how we would structure something.
I'm just thinking, just maybe as an example, putting some numbers around it. Let's say you've got a client that's on, 80 or 100K, right? They're trying to buy a 900K property, but it's going to be a bit of a stretch, but they really want to do it. But the only way, they can't get it through the majors like ANZ or CBA, but yeah, they could go with a Liberty or something, right? But instead of paying 6.5%, they're going to have to pay 7.5%, something like that.
Yeah.
Okay. Yeah. So you put them into that strategy. They go, oh, but I don't want to pay the extra 1.5%. And you go, well, it's either that or don't do it at all, right? Now, those that go, you know what, I can see it's worth paying that little bit extra on the lending because I know the property that I buy is going to go up 10, 15, 20% or more over that next 2-year period. So is that the kind of advice you're giving?
Yes, absolutely. And we see it more and more, and we've seen plenty of people do well in the last few years, especially.
I think it's really good that you can have a roadmap for those clients because a lot of people just focus on the rate, So, yeah, I want to talk to you about equity, this concept of equity. Some people still don't get equity, right? But can you explain how investors can leverage their equity from existing properties they might own? And if you're in the accumulation phase, how can you maximize that leverage in your borrowing capacity?
Yeah, for sure. So I might just use the most common example around saying that you need to have 20% in your property. Now, there's lots of ways that we can get around having less than 20%, but for simplicity, let's use that. Most of the time, most homeowners will buy their own principal place first, generally. And with that on your principal place, most homeowners' goals is to pay off that debt as soon as they can. So what happens with that is over time, historically, property has gone up. You've paid down your home loan and you've created equity in your property. And the way that you leverage off that equity is you put that place up as what you would call a security and you purchase your next investment property. Now, the best thing about that is the accountants generally advise you to increase as much debt as you can on your investment property to help you with some potential tax advantages and really pay down that own home as much as you can. And over time, people can continue to leverage off their own home while paying off that debt and then just really start up that portfolio. And they might go every 2, 3, 5 years, be able to buy a new property because they've built that equity in that home.
That's excellent. Yeah, cool. I mean, that's what my wife and I did to build our portfolio. We bought our first home in Sydney in Pennant Hills many, 25, 30 years ago. And we paid 245 grand, the paltry sum. We thought it was a lot of money at the time, the equivalent today would be paying, like $1.5 million for it, And then, as the markets increased in value, we leveraged off that to build our portfolio. But it was a bit scary at first because I thought, gosh, I've almost paid my home loan, got it down to 50 grand. What am I leveraging it up another 150 to buy 2 properties for? What's that going to do? But once someone sat me down, explained the numbers and the tax effectiveness of doing that strategy, it was so good. I mean, the very, very conservative people, or used to be financial planners out there, say, oh, don't risk your own home. But the problem is you actually create your home is an asset. Your home is an integral part of your wealth creation journey, right? So if you don't use it, it's going to take you even longer to start building a portfolio, So, you've just got to do sensible risks and sensible borrowing, not over leveraging. And I'm sure you manage those numbers in your advice, right, to your clients?
Oh, absolutely. Definitely. Yep.
So talk to me about, I guess, your particular role as a broker. What's the advantage of using a broker to get finance versus going to a bank directly? And also what might be your particular competitive advantage over other brokers?
Yeah, definitely. So mortgage brokers have access to 30 plus different lenders, like lots and lots of different lenders and options. And within those lenders, they've got multiple options that you can sort of choose as well. So you've got a suite of around 100 products that you can help a client with. If a client went into an actual direct bank or lender, they might have 3 or 4 products that they can help a client with. So obviously, with that choice becomes the competitive advantage around rate, helps you with being able to be approved, and you've just got that real select choice of how you want to have your finance structured, and you're not bound by only one lender. So when you look at, as we said earlier, over 70% of the market are working with brokers now, I guess the market's kind of gone, well, that's the way that we prefer to be dealt with in the finance sort of way of things.
Yeah.
And then if you look at someone like ourselves, so there's lots of brokers that have entered the market now. There's over 10,000 across Australia. So what's our competitive advantage? When you are choosing a broker, it's very important to choose someone that is experienced, knows what they're talking about, and has good relationships with lenders. And you're only going to get experience by having volume and actually helping as many clients as you possibly can. And we've been around for sort of over 10 years now. Within our group, we've got over 150 years of experience within finance. And we do that volume of business to lenders, but they do give us premium sort of, memberships. And within that premium memberships, we get fast credit approvals. We get quicker turnaround times. We also sometimes get favorable rates. And so all of that just comes back to why it's important to choose the right broker with the right experience. As opposed to potentially someone that's just entering the broker market.
That's good. I think the other advantage that brokers like yourself present is that you can position the client in the best financial light. I mean, some people have pretty complex structures. They may not be POAG earners. They might be business owners or have a complicated trust structure. And so knowing which lender and their policies is a huge advantage before you make any applications. I mean, I'd hate to run around to 30 banks and try and get the best rate. That'd be just a nightmare. I just don't have the time for that. And you get paid by the bank, so your service is effectively free, right? Because you're remunerated by the banks. Is that right?
Yeah, correct. So when you mentioned the trust structure and the complex lending, commercial backbone. So that's our bread and butter. And absolutely, it's not particularly easy. So some people struggle with it. So that's why. Yeah, we definitely have an advantage in there. And you're right. More often than not, a lot of the time the lenders pay us. And so we work for the client, but get paid by the lender, which is a really good deal for people.
Fantastic. That's excellent. So I also want to talk about the impact of interest rates. So how do, changes in interest rates influence property investment decisions and financing? And have you noticed there's been quite a hesitation in the market for loans, or are people just getting on with it despite where rates are sitting at the moment?
People are getting on with it now, definitely. What we've seen with interest rate increases is it generally just scares the market around some speculation that rates are going to go up. And we know, like over the last 12, 14 months prior to, rates just went up and up and up. Now we've had a really steady period over the last while, which has been really advantageous, and people are getting on with it now. When you sort of look at, the next year, you also look at how steady it looks from a rate perspective. And therefore, we've seen our last quarter probably be the most amount of people ever buy a property. I sort of attribute that to people getting that confidence and getting on with it now.
I think so many people, unfortunately, make decisions about buying a property purely based on the interest rate or the cash rate, and people used to think that, if interest rates go up, then the property market's going to crash. But in fact, what's happened in the last 18 months, that interest rates went up 13 times and property prices rose significantly over that time. So there's never a direct correlation necessarily between interest rate movements and what happens with property prices. You've got to look at the other factors that influence property prices, like supply and demand and immigration and population growth, because all of those have much more significance than just the cash rate.
Yes, correct.
We really appreciate you tuning in to the Propertybuyer Podcast, and I hope that you're finding our expert interviews helpful. So that we can keep providing this information and growing our audience, we rely on word-of-mouth recommendations. If you found this information useful, could I please ask you to share this podcast with your friends, family and colleagues and ask them to subscribe to the Property Buyer Podcast. It would be a big help and we'd be very grateful for your support. Thanks once again for sharing the links. And now let's get back to the podcast. Josh, tell me about, we just touched on this briefly, but about diversifying lender relationships. Is it actually beneficial for an investor to have multiple lenders? What's the pros and cons of having different lenders versus putting all your lending with one particular lender?
Yeah, definitely. And to be honest, Rich, when someone is an investor, they do have a diversified portfolio. It's quite rare that they'll all be with that same lender. So I touched on it before. I'd say a big con with having multiple lenders is just that part. If you wanted to go and have to deal with them all yourself, then it can take time out of your day. And a lot of investors that we see, and I'm sure you see too, are really busy people and they don't want to have to go and deal with all of that. And hence why when we come in, we help them with that diversification and dealing with that inefficiencies. But the best advantage of that, and I mentioned this earlier, so you might have Bank A that wants to give you all this money 1 year, and then they had some changes in policy. They got a new CEO or they're tied heavily to America and they want to pull back their funding. And then the next year they don't want to give you any money. So now we need to go to this next lender to help that client continue to expand their portfolio. So it's so important to build that portfolio, to have relationships with multiple lenders, definitely.
Okay, fantastic. And in terms of the actual loan products that are available, do you have like software that kind of calculates the best type of loan product and that's going to suit the investor's strategy or personal circumstances? How do you decide which loan product is going to be best for a client?
Yeah, we do. Tech's been amazing in our industry of late. We do have tech that we can put in some circumstances and they can give us some guidelines. Now, we definitely have a team that research that tech and make sure that that's the right suggestions. And then we make a decision based on, a human decision based off that tech. But we do have that to put in a scenario and situation that then helps us, select probably 10 lenders. And then we can narrow that down to our best 3 and we can work out what would be the suggested route from there.
So would you recommend that someone does the DIY approach that just goes to ChatGPT and says, hey, I've got 800 to spend, give me the best lender? Or do you recommend they go to a broker and get that combination of tech and human advice?
Yeah, I think I'd go the latter. I think there's one thing that's not ever going to go out of the broking industry or any industry is that human touch. And yeah, definitely.
Okay, fantastic. If you're enjoying this podcast and feel like you're getting good information, please share the link with your friends and colleagues who would also benefit. Actually, Josh, I'm going to do that again because I just forgot to do the head to the break. So what time is it? 21:50. I'll just get them to edit that. 21:50. Oh, Josh, that's fantastic information. Thanks for that. Josh, we're just going to take a short 20-second break and we'll be back right soon with some more questions. If you're enjoying this podcast and feel like you're getting good information, could you please share the link with your friends and colleagues who'd also benefit? If you've got any questions you'd like to ask on future episodes, please go to the right-hand side of our podcast page and click on the speak pipe to record your voice question, and I'll respond to that in future episodes. And just before we get back to Josh with more questions, if you'd like more information about our buyer's agent service around Australia, please reach out and call us on 1300 655 615. Email us at info@propertybuyer.com.au or send your inquiry via our web forms. We'd be delighted to assist you. So Josh, just getting back to the questions for you. I've got a few more to second half of our podcast. And thanks so much for your insights today. It's been great. I want to talk about managing loan to value ratios, LVR. What role does LVR play in financing, and how can investors manage that to optimize their borrowing capacity? Like, should you go to 90% is what I'm asking, for example?
Yeah, definitely. So LVRs is very important when you're building a portfolio. And should you go to 90% or should you, stretch that leverage? Then I guess our point before around if you don't, what are you missing out on? And what we see with around how people leverage, and this is probably not the most known part around how this impacts your serviceability. lenders give you a lot of negative gearing benefit if you maximize your investment lending on an actual investment property. So if you structure it wrong and you gear up or maximize your lending on your own home, you're going to miss out on a lot of negative gearing benefit, and you're not going to be able to borrow as much. So when you're thinking around how do I structure this and what LVR should I be apportioning to which property, very, very important.
So is it worthwhile paying lenders in mortgage insurance? Like, my understanding is that once you go over 80% LVR, you're going to pay LMI, lenders mortgage insurance. And that can be 1%, even up to 2%, right? Once you get into the higher LVRs. So do you think there's a role to do that? And what are the risks of doing that?
Definitely. So I'll get into LMI. And before I do, I'll just quickly mention that there are professional roles out there, such as medical professionals, lawyers, accountants, that can get into property for a 10% deposit and not have to pay LMI. So there are sort of some unique circumstances for people. People that do pay LMI, absolutely. Like we sort of touched on it again before, and we look at the market outlook into next year, and I sort of mentioned Queensland, if you like, and there's been reports that I've seen it's like 9 to 14% growth that they're looking through, and other states have different sort of growth targets, and I know you'd know more about that than I, Rich, doing what you do. But if you don't buy a property today because you're going to have to pay a 1% LMI premium, and that property goes up 10% the next year,
exactly,
you're going to be kicking yourself. So absolutely, clients pay LMI, and that's the take on it.
I mean, just my own personal strategy, Josh, what I've done is very early on in my investing career, I just maximized to the hilt. You know, I went to 90, even 95% on some properties. I remember paying 2% extra premium on the lending just to get into two properties at the same time, because I knew they were going to go up in value significantly, and they absolutely did. And that was really worthwhile. And again, you can amortize that cost or write off that cost over 5 years. It's all part of the borrowing cost of getting into the investment. So it's definitely worth doing. And for me, it was a choice between buying one property at 80% or two properties where I could split my 20% deposit into two different properties. So it made a lot more sense financially to do that. You probably wouldn't do it if you're age 60 and above, you know, but if you've got a good runway of another 10, 20, 30 years ahead of you, you know, going that route of optimizing. But again, it's not a one size fits all here for people. I think you've got to get good financial advice before you do that strategy. Josh, let's talk about the bank of mum and dad, right? It's a pretty popular topic, right? We're seeing it there. So first home buyers, how many parents are assisting their kids with either cash or equity to get into the property market at the moment? And do you think that parents should be and kids should be aware? What should they be aware of in these situations?
Yeah, absolutely. And they are. That intergenerational wealth is a big part of what people are talking about. And there are parents that have built up and done a really good job and built up, some good cash and want to help their kids out. And banks actually are more than happy to accept that. So a few myths may be that if parent gives their children $200,000 to help them buy their first property, one of the myths that people might go, the bank might not particularly love the fact that the parents are giving them $200,000. Most banks are fine with it. You just need to have a stacked deck to say that it's a non-refundable gift, and the lenders will be fine, and it's all good, and you can sort of move on. Another way that parents are helping their children get into property is putting up their own home or their investment property as security, and enabling the kids to effectively not really have to have too much of a deposit. As long as they got the serviceability, they can buy that property with the help of the parents.
That's it. Well, that's to that point exactly. Just a personal example, Josh. Just 2 weeks ago, I've just helped my son buy his first property. Hooray! So we I don't know if I told you this prior, but no, we just said to him, look, if you can save $100,000, then we'll match that as an equity guarantee. So he's done that. He's done really well. He runs his own little business and got married a year and a half ago and bought his first property. So they're stoked and we're really happy for them. So I think that's a great way. And it's not a cash gift. It's just, as you say, it's an equity guarantee. So he's got to pay it off, but he's just using our equity to leverage against. So I think it's a great way for parents. But I think it's also good to incentivize your kids to have some financial discipline in their lives, you know? So, yeah.
Absolutely. No, well done.
Let's talk about the tax implications that might affect financing decisions. Like, what are the sort of things that investors need to be mindful of when they're borrowing and the tax implications?
Yeah, for sure. So tax implications are massive when you're looking into buying an investment property. we talked earlier around like what entity you're going to buy in, and that can have big tax implications when you are going to do your returns. So if you're buying an investment property in your own name and you're at a high tax bracket, then that might mean that if you're getting rental returns from that, you're paying more tax than what you need to be. If you're buying it in a trust or another structure, then that income that you receive from that property may be able to be dispersed through people in your family that you're not earning, that isn't earning your tax bracket. So big tax implications. And we see people buy a property without the strategy too often, and they should be getting that advice straight up.
Yeah, it's really good to have the right team around you. You know, you've got to have a good mortgage broker, a good tax accountant, good solicitor, a top buyer's agent, and that's going to be a formidable team in helping you to make great decisions. And I've seen plenty of people make mistakes. The other one around tax is that people think, hey, I'll get an equity lend or a cash out, and I'll just go and buy a boat and hopefully claim it as a tax deduction. Well, unless you're running a boating business, you can't claim it as a tax deduction, right? So you've got to be very careful what you use the money for before you claim it as a tax deduction.
Absolutely.
Yeah. Josh, if in terms of investors coming to you and getting pre-approval, what can they do to make your life easy? In other words, what can they do to prepare themselves to get that property pre-approval so it sails through?
Yeah, look, a few things. I mentioned earlier around paying your credit card, paying your all of your bills, having that bills account and having lots of money in there, as much as you can in terms of covering all of your direct debit expenses, paying your home loan, making sure your direct debit is set up properly. Lenders don't take the fact that you say, oh, this direct debit wasn't set up properly by the lender. It doesn't get accepted in the market to say that's an acceptable excuse. They put the onus on the actual investor or person to look after their affairs efficiently. So I would say that's the biggest thing that we would see in terms of your credit piece. And the other one is always have at least something that you're trying to pay down debt on. So if you're wanting to prepare yourself to leverage equity, always make sure that you're having some sort of strategy that you're paying down some debt, or as you would have had amazing advice from yourself and you bought a property that's increasing. So yeah, that's how you can prepare yourself best to have finance.
Cool. The other things I'd probably just add to that, Josh, is just have a simple budget. You know, get an Excel spreadsheet. If you don't know how to make one, get someone to help you. Have a household budget. Pay off your debts, put it into buckets, and if you've got multiple properties, put them in a spreadsheet, because brokers love it when you've got everything prepared and they're not having to pull different numbers from all different documents. So make it as easy for your advisors as you can, and they'll make your life easier and get your approval done a lot faster.
I'll probably just add to that, Rich, and it's a good point around the budget. We do have one on our website that we've created that does help, especially those first or second home buyers. And it does help them, have that roadmap to being able to buy property.
Awesome. Yeah, I think, just having goals and being accountable to someone, I think is a really great way to spin finances. If you go to the gym, you got to eat right, you got to train right. You're not going to lift 150 kilos on your first workout. You've got to work up to it. So same thing, you're not going to buy $16 million worth of property in your first go. So you've got to start somewhere and then build up to it. Got a couple more for you, Josh. With the market changes, how can investors adapt their finance strategy in response to changing market conditions, or shouldn't they change? What's your thoughts on that?
Look, they definitely will need to change at certain points. If we look at historically, what I would say to investors from a finance perspective is to review your portfolio every 12 months from a finance perspective, because no lender's going to ring you up and say, hey, Rich, well, they might, but it's very unlikely. Hey, Rich, I know you've had this loan with us for a few years. I'm going to reduce your rate because we love you.
Yeah, I've never had that phone call. I can tell you. Don't worry. Yeah.
So you do need to be proactive with it. If you're dealing with us or a mortgage broker, with us in particular, we will be proactive. We do call you every 12 months and suggest that review. And sometimes it might be just that peace of mind to say, hey, not much has changed in the market the last 12 months. You're fine. Keep doing what you're doing. And that next 12-month phone call might be, hey, this lender over here is doing this, and that's going to help you buy your property and also reduce your rate. So that's what I would suggest, is definitely things change all the time, and you need to review at least every 12 months.
The banks love the set and forget investors. They love them because they make more money out of them, whereas the ones that are proactively revaluing their portfolio, going to people like yourself and refinancing is a great strategy to save money and build more wealth.
Correct.
Tell me about, I guess, any thoughts around the future trends in property financing. Are there any emerging trends you foresee coming in the finance industry and anything investors can take advantage of?
Yeah, so in terms of trends, like you mentioned earlier, there's things that happen in the world that, pop up every now and then and we can't control. But when you look at next year and the year after, and it seems like the trend is that we're going to have some steady times. Now, that hasn't happened in a while. And I think the thing or the piece to take advantage of is we're going to have some steady times. Lenders are seeing things as steady. They're getting pretty comfortable around wanting to lend to people. So if you are going to buy or you are going to make that decision, in my experience, a lender will give you money probably when you don't need it so much, but you can get it. And when you really need it, they won't give it to you.
Exactly. Can I just say, Josh, those words of wisdom out of your mouth then is gold. And if anyone's listening to this, take note of that. So you might want to say it again, Josh, but that's gold, right?
Yeah, absolutely. And that's so basically, I already mentioned it, but when you're looking to if you're not sure if you want to buy a property yet, but you can get the funding, we do. It sounds like a sales pitch, but it's genuinely not. We do advise to say, hey, what I just said before, lender will give you money when you don't really need it, and when you need it, they won't.
Yeah. I just know for myself, I've set up lines of credit or offset accounts, even though I didn't need the money at the time, but that's been a godsend literally a year later when I've either needed the money or found an opportunity to buy something. So, you definitely want to keep reviewing your portfolio, reviewing your finances every 6 to 12 months and get yourself in that position of on the front foot. What's your advice for aspiring investors who want to build a portfolio? What would you say to them?
Yeah, so you got to be surrounded by the right professionals. So if you want to build a portfolio and you want to do it around investment properties, you need to have the right buyer's agent, you need to have the right accountant, right lawyer, and right mortgage broker. And if you're surrounded by that network of people that work with each other to help you, and they all have that common goal around helping this client create wealth, that's what I would say. Before you even look to start the portfolio, you pick up the phone and talk to your property buyer's agent, you talk to the mortgage broker, and generally they'll have that network that will help you create that portfolio going forward.
Cool. And Josh, final question. What's the best piece of advice, investment advice you've ever received that maybe you could share with our audience today?
Yeah, for sure. So back a winner. So often people think, because things are going down, I should buy. And because things are going up and I could have got it cheaper yesterday, I shouldn't. There's often a reason why things are going down. There's often a reason why an asset's going up. If an asset's going up, it's because it's good and people want it. So probably the best piece of advice I had is don't get too confused or worried about the fact I could have bought this property cheaper yesterday, because it's been going up and it's a good thing. It's going to continue generally to go up. So yeah, back a winner is basically the best advice I've ever had.
Yeah, I think the other point just on that is waiting for the perfect time to buy. It's really hard to pick that exact month or week in the year to buy. And honestly, just buy when you can afford to, and you're going to do well. So, and Josh, if someone wants to get in touch with you and talk about getting finance, what's your website?
So their website is www.thebrokerage.au. And that's the best way to look us up on the website, and all of our contact details are there.
Fantastic. Well, Josh, thank you so much. It's been an absolute pleasure. You're a font of knowledge. You've given some great tips that I'm sure our audience will love, and really appreciate you being on the podcast today.
Thanks for having me, Rich. Appreciate it.
Thanks, everybody. Thanks for being with us on another Property Buyer podcast. If you have a question you'd like to ask, please click on the SpeakPipe link and we'll answer this during the next episode. If you're looking to buy a residential or commercial property in the near future and would like to get the added advantage of having a buyer's advocate on your side, then please reach out to my team today and send us your inquiry, and we'd be delighted to help. Please visit our website at propertybuyer.com.au, where you can stay updated with all my latest market updates, weekly blogs and live suburb profiles to help you make better property decisions. We look forward to connecting with you again on the next Property Buyer podcast.